Jeremy Corbyn was awoken in the night to the sound of his back garden being dug up by Chancellor Rishi Sunak. It turns out he did have a magic money tree all along, and it's now been stolen by the UK government.
Which is fantastic because now everyone gets free cash for doing sod all. Want this steak? The government will pay for that. Is your business too inflexible to adapt to changing times? Have £10,000 from the taxpayer. Your boss still can't afford to employ you after 4 months of furlough? That's fine. Have another 3 months, all expenses paid. We can worry about the inevitable later.
Unfortunately, while Jeremy claimed to know how to keep a magic money tree fed and watered, the Tories have not yet discovered the secret, and the magic will inevitably end. When the fun ends, it'll be you and us, the taxpayers, and British companies left to sweep up this mess.
Does this mean the UK economy is screwed long term? What about the stock market? Let's check it out.
Welcome to MoneyInShackles.com, the investment and finance channel and website that sets you and your finances free.
That was Andy and I'm Ben, and if you like what we say, hit the like button, click subscribe.
The Magician's Secrets Explained. The country's finances are being kept alive through money printed by the Bank of England. The sums are ridiculous, £300 billion of artificial money. Alongside this, government debt went up by £173 billion in the last year alone to an eye-watering £2 trillion, and they don't seem to be worried about this in the slightest.
And that's because right now they can borrow without fear. The Bank of England is the magician's assistant hiding out of sight. The government can get into as much debt as it likes because the bank will mop it up by printing a load more cash, giving the government unlimited borrowing power.
It means that money is literally endless. This creates an artificial market keeping borrowing rates low. But how long can we keep getting something for nothing?
Nobody cares about the deficit. The deficit. We're bored of hearing about it, and the government are bored of pretending that they're trying to fix it. Now that interest rates are super low, their view is that if they can afford to make the interest payments, then it doesn't matter how big the debt is.
The UK can borrow right now at just 0.25%, which still costs tens of billions of pounds to service. The UK's debt pile is so big that even an interest rate rise to 1% would cripple the Treasury. This is why interest rates are expected to remain low. The country would go bust if they were raised. I'm so confident in this that I opted for a tracker mortgage on my home because I cannot see interest rates rising anytime soon.
A chance to splash out. The COVID crisis has allowed the Tories to turn on the spending taps in a way that their voters could never justify during normal times. They have done this so far in the name of one-off targeted measures aimed at countering the coronavirus.
But now they're going beyond that. Have you ever noticed that once you start spending, it's tough to stop? Well, billions are being poured into green agenda projects and welfare schemes that will either become unstoppable annual expenditures or could have sensibly been deferred until we can afford to pay for them.
The government can get away with splashing the cash right now on non-essentials because they're spending so much on COVID countermeasures that nobody in the media notices a few extra billion. But the markets are keeping note of all of this, and we believe there will come a reckoning. Britain is not plunging itself into more debt from a position of strength. It started the virus period financially weak, and it is making itself weaker.
Stock market impact. The country's basically screwed, but the stock market doesn't seem to care. FTSE companies have been enjoying handouts left, right and centre during the crisis, so in the short term they should be okay. The government has been so overly generous that some honourable companies such as Primark have rejected the government handout, which would have netted them £30 million.
In the medium to long term, there may well be a market correction. The FTSE 100 index of the UK's leading stocks is up over 20% since we went into lockdown. Bull market territory. Stock prices are up, bond prices are up, and a lot of this is due to government interventions. They are also doing their utmost to keep property prices artificially inflated. By giving boatloads of magic money to companies and to employees, companies which really ought to have folded have been allowed to limp on. Their workforces temporarily nationalised.
Either the government will somehow manage to square this circle, or the magic money will run out and the system will collapse. If you are an investor or have your pension in the stock market with a significant UK holding, you might want to start looking at mitigating measures.
Diversify globally. A properly diversified global portfolio will only have a small part of its allocation dedicated to the UK. The Vanguard FTSE All World ETF is one benchmark to use. It is a global stock market fund which tracks an index of large and medium-sized companies from around the world by market capitalisation, and it has only a 4% exposure to the UK.
Diversifying globally is the best way to defend against times when governments go rogue. Governments that forget that debt needs to be paid for one day. Check your pension pot or investment portfolio is not weighted too heavily towards the UK or any one country.
That Vanguard All-World Fund isn't perfect, as it has 57% of its value in the US, which is more than we like right now, considering the US is the most indebted country in the world. Check out our recent video on how to invest £10,000 for ideas of how to weight your own portfolio.
How the UK compares to other nations. To get through this COVID era, Britain has had to borrow more than almost any other developed country. Its debt finance spending is higher than Italy's, Greece's or Spain's, and those countries are not exactly famed for their economic excellence.
If there's a crash in China or a boom in Africa, Britain's ability to react with interest rate manipulation will be limited, and if interest rates go up by much, the country is broke. The UK has not come close to balancing its books for nearly 2 decades now. There has never been a plan for how to pay for healthcare, state pensions and public services in the long term.
The refrain of let's give more money to the NHS is rarely followed by how will we pay for that? And an annual clapping day is not the same thing as a long-term funding plan. The US is more reliant on debt than we are here in the UK. But as the world's main economy, the US has had the weight and the teeth to control its own destiny in a way that the UK simply doesn't.
The US dollar is the currency of the world, while the UK pound sadly will not be missed by many outside of these shores if it becomes worthless as a result of magic money.
Keep watering the tree. Right now, it's in for a penny, in for a pound. The UK is so dependent on magic money that it needs to make more and more of it to function. We're already starting to hear rumours that income tax and VAT will have to be raised, pensions cut, and the possibility of introducing a wealth tax in order to help pay for everything. That free money will soon be forgotten, but the consequences won't.
If history has taught us anything about money trees, it's that the more they're used, the more the magic wears off. Question of the day: are your investment or pension portfolios diversified enough away from the UK? Let us know in the comments below.
Thanks for watching. On this channel we talk a lot about personal finance, investing and all things money. And if you want to see more great content, please click the subscribe button below.
This is MoneyUnshackled.com. See you next time.